According to one of the main rules of Elliott wave theory, ideally, wave 4 should retrace between 50% and 61.8% of the Fibonacci retracement of wave 3. To avoid missing out on potential movements, we set our entry point for Elliott wave between 50% and 61.8% based on price action signals formed in that area. In many cases, bullish engulfing and bullish pin bar patterns often appear in this area. However, experience can help refine this entry point for better accuracy. Hey guys, welcome back to another episode. In this video, I will demonstrate how to trade Elliott wave and Fibonacci retracement with precision. As usual, this video provides a clear, winning, step-by-step guide to how to successfully trade in the forex, stocks, commodities, or any financial markets and generate consistent profits. By the end of this video, you will have a clear understanding of when to enter high-probability trades using the Elliott wave and Fibonacci retracement techniques. So let's get started. What is Elliott wave theory? The Elliott wave theory was developed by Ralph Nelson Elliott, who was an American accountant and author. He was inspired by the Dow theory and his observations of nature to conclude that the stock market's movement could be predicted by identifying a repetitive pattern of waves. Elliott's theory went beyond the Dow theory by analyzing markets in greater depth, identifying specific characteristics of wave patterns, and making detailed market predictions based on these patterns. He discovered the fractal nature of market action, which he outlined in his book The Wave Principle, published in 1938. This theory provided a more comprehensive explanation of price movements in terms of waves, thus helping investors better understand and forecast market behavior. Elliott wave theory. Impulsive waves versus corrective waves. The Elliott wave theory is a technical analysis approach that involves observing a pattern of 5 consecutive waves before making trading decisions. The theory distinguishes 2 types of waves: impulsive and corrective waves. First, impulsive waves move in the same direction as the overall trend, and they reinforce the trend. Second, corrective waves move against the overall trend and occur in a series of 5. Understanding market structure requires knowledge of the underlying principles of impulse moves versus corrections. This concept is critical for identifying support and resistance levels, which can be helpful for traders. To increase the probability of earning strong returns, traders can use impulsive and corrective waves as part of their trading strategies. Additionally, understanding moving averages can also be useful in trading. How to trade Elliott wave. The Elliott wave theory is popular among traders because it incorporates both technical analysis and fundamental news. The theory is based on the cyclical pattern of market events, which means that even after a severe economic downturn, conditions are likely to revert to their previous state eventually. The basic principle of the Elliott wave theory is that prices move in specific patterns over a particular time period. Ralph Nelson Elliott discovered that any trending movement can be broken down into a sequence of 5 waves, which he labeled 1 through 5. As per the Elliott wave strategy rules, waves 1, 3, and 5 tend to occur in the direction of the trend, while waves 2 and 4 represent price movements against the trend. In the case of a 5-wave move in the direction of the trend, Elliott wave theory suggests that there will be a corrective 3-wave movement in the counter-trend direction, which is labeled A, B, and C. This approach provides traders with a useful tool for identifying potential market trends and making trading decisions accordingly. According to Elliott wave theory, the 5-wave move represents the direction of the trend and is also known as motive waves. Conversely, the 3-wave corrective move goes against the 5-wave move and is referred to as corrective waves. This is a helpful approach because it allows traders to break down any price trend movement into a basic 5 to 3-wave pattern. Each impulsive and corrective move is a series of waves oscillating up and down, illustrating that there are waves within waves. The basic rules of Elliott wave theory. The Elliott wave theory has 3 basic rules that must be followed to validate the 5-wave move. Rule number 1. Wave 2 should never retrace more than 100% of wave 1. Typically, the retracement is between 50% and 61.8% of wave 1. Rule number 2. Wave 4 should never retrace more than 100% of wave 3. Typically, declines between 38.2% and 50% of wave 3. Rule number 3. Wave 3 should always travel beyond the end of wave 1 and should never be the shortest one, Wave 3 will usually extend 161.8% of Wave 1. To play the Elliott wave strategy, it's best to let the first 4 wave movement unfold and then find good Elliott wave entry points near the end of Wave 4. This is done to try and catch the last wave of the entire 5 Elliott wave sequence. Where to start Elliott wave count? To begin an Elliott wave count, traders have several methods they can use, but the best approach is to start at either an extreme swing high or low. For example, starting the count at a high identifies a movement to the downside, while starting at a low identifies a movement to the upside. However, to find higher degree Elliott wave cycles, it's necessary to count waves on weekly and monthly charts. The Elliott wave theory suggests that the count should start at the end of the previous impulsive wave. Nevertheless, a challenge in Elliott wave analysis is that the wave count can be subjective. Let's move forward. Having understood the fundamental concept of Elliott wave, let's now examine some of the Elliott wave entry points that our team at Trader DNA employs. Step number 1. Wait until you can spot at least a 3-wave Elliott wave sequence. The first step in the Elliott wave strategy is to wait until you can identify a 3-wave sequence. The good thing about the Elliott wave strategy is that it doesn't require any technical indicator, as it's a pure price action strategy. Trading in the direction of the trend, the goal is to capture the last wave 5. To do this, traders must observe the first 3 waves of a 5-wave pattern and verify that they comply with Elliott wave rules. For instance, in a bearish Elliott wave count, the wave count must adhere to the rules for the Elliott wave strategy, allowing for a sell setup. Once this is established, the next step is to search for the Elliott wave entry points. Step number 2. Buy between 50% and 61.8% Fibonacci retracement of Wave 3. According to one of the main rules of Elliott wave theory, ideally, Wave 4 should retrace between 50% and 61.8% of the Fibonacci retracement of Wave 3. To avoid missing out on potential movements, we set our entry point for Elliott wave between 50% and 61.8% based on price action signals formed in that area. In many cases, bullish engulfing and bullish pin bar patterns often appear in this area. However, experience can help refine this entry point for better accuracy. Step number 3. Set the protective stop loss a few pips below the swing low. It is advisable to place your stop loss a few pips below the recent swing low. This is because this position ensures that your stop loss is not too large or too small. The purpose of this is to help you achieve your money management target, which is a risk-reward ratio of 1 to 3. After setting the protective stop loss, the next crucial aspect of the Elliott wave strategy is to determine the profit-taking strategy. Step number 4. Decide when to take profit based on your stop loss. Once you have determined your stop loss level, it is important to set a profit target that is 3 times the size of your stop loss. This ensures that, in the long run, your trades will remain profitable. The beauty of the Elliott wave strategy is that it allows for experimentation and the development of unique trading approaches. Once you have a solid understanding of how to trade using Elliott wave principles, you can create multiple strategies that work best for you. Auto Fibonacci Retracement Indicator. An excellent tool for plotting Fibonacci levels easily. How the Auto Fibonacci Retracement Indicator works. The Auto Fibonacci plots the retracement levels between 0 and 100%. If the market is bullish, the 0 is at the top and 100 points at the bottom. And vice versa, if the market is bearish, the 0 is at the bottom and 100 points at the top. Besides trading pullback, the Fibonacci levels offer great take-profit levels when riding the trend. By using this indicator, you will no longer struggle with implementing Fibonacci and Elliott wave. With this tool, all you need to do is analyze and execute trades. It is incredibly useful for both experienced traders and beginners alike. This should be simple enough. Or, in this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Here are other examples of the Elliott wave price action trading strategy. Billionaire hedge fund manager Paul Tudor Jones is renowned for utilizing Elliott wave analysis in his trading approach. This trading technique has been a proven and tested approach over time. As such, there are several methods to trade using Elliott wave theory, but the effectiveness of your trading decisions will depend on your experience and ability to correctly identify Elliott wave entry points. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.